The following is a recording of a conversation I had with Rick Rule on the 5th of March, 2022. My name is Apattanaik, and I am an investment advisor at Sprott Global, based out of our office in California. As we are recording this discussion a few weeks ahead of Rick's Uranium Bootcamp, the content here is intended to focus on certain topics within the uranium sector to help investors maximize what they take away from this event. I want to also point out that small commodity markets like uranium and silver share certain dynamics. So as the fundamentals improve in the precious metals group, you may find some of the learnings from your uranium investments applicable to the investment selection process in the silver market. Rick, you've had the opportunity to rank over 8,000 uranium-centric portfolios over the last 14 months. I was very keen to know what you would ideally like to see uranium investors take away from this event and also do differently over the course of this cycle based on your interactions with them over the last 12 months or so.
As you point out, I've graded or ranked, 7,000 or 8,000 portfolios that were at least uranium centric. And I've corresponded and communicated with more than 100 of them individually, either responding to their questions or asking them questions about the composition of their portfolios. And what I've learned is that there was a distressing lack of knowledge around uranium. So in the boot camp, what I want to do is give people enough knowledge about uranium that they can either say, I don't want to be in the sector, I'm going to leave, or I know enough about the sector that the bullish prognostications make sense to me for the following reasons. So in the beginning of the boot camp, we're going to have a uranium market overview by WMC consultants, who are the consultants to Sprott around the Sprott physical uranium market. I recruited them for the seminar because they did uranium markets overview for the Sprott board when Sprott took over Uranium Participation Corp. And it was the best 1 hour overview of most aspects of the uranium market that I've ever seen. And I've been studying the uranium market for almost 40 years. This presentation was great technically, but it was also skillfully enough presented that people who weren't before this familiar with the uranium market came away with enough functional knowledge that they could understand why Sprott was doing what it's doing. The reason, or one reason at least, why it's important for investors to have good fundamental knowledge around uranium is that when the uranium price moves up, it's not going to go in a straight line. It's going to be highly volatile. There will be circumstances where the uranium price falls in 2 or 3 months by 20 or 25%. And investors that have knowledge have the courage of their convictions so that they can't be shaken out in a move like that. They can't be shaken out of volatility. It's very, very important that people have this necessary overview. I would suggest of the 7,000 portfolios that I looked at, maybe 100 people, maybe 200 people had sufficient knowledge of the uranium business that they would have the courage of their convictions. And the price action that you've seen in the uranium sector in the last 7 months suggests that the hot money, the new money, didn't have the courage of their convictions, which I'd like to address. We're going to talk about the politics of uranium. Because uranium is uniquely affected by politics as a consequence of Chernobyl, Hiroshima, Nagasaki, Fukushima, 3 Mile Island. So a discussion of the politics, and in particular, the changing politics, the trade-offs between perceived risk, real risk, and the risks of uranium substitutes like coal need to be discussed because it's a very political commodity. We are going to have China General Nuclear, a publicly traded Chinese parastatal that's the most important nuclear entity in China, talk about the Chinese view of the uranium market and the Chinese the Chinese plans with regards to plants currently under construction and plants that are being permitted and financed for the future means that China is the single most important variable in the uranium price over the next 20 or 25 years. We're going to have a discussion of uranium supply and economics from Kazatomprom, which is in excess of 40% of the world's supply of uranium. Their own investment decisions and production decisions are probably the single most important variable on the supply side in the business. And then we're going to have a presentation by Cameco, the largest uranium company in the world by market capitalization, talking about Western world and developed nation dynamics, supply and demand dynamics. We're going to have two analysts in the uranium space that have been involved in the sector for 20 years and 30 years. There's a lot of online information that is being purveyed by some very good public speakers, but people who 5 years ago might not have been able to spell uranium. And while a lot of this information is well-intentioned, the people who are giving you the information don't have the benefits of prior bull markets, prior bear markets, and in many cases, certainly don't understand the dynamics of uranium exploration and development, among other things. So I think by the end of 8 hours, people will know why they do or why they don't own uranium. And they'll also begin to have a very good sense of when to sell, a lesson that they may forget. It's easy to get swept up in the emotion of being right. But it's important to know not merely why you would buy and what circumstances would cause you to hold, but also what circumstances might cause you to sell. And I think we can accomplish all of that. I should add, Aditya, that I'm confident enough in the value of the curriculum that we propose to teach that anyone who pays me the $99 to attend and attends, in other words, spends 8 hours listening to the material and believes that they didn't get their money's back, money's worth, pardon me, are entitled to a full money back guarantee. The financial risk is mine.
One of the gaps that I've seen based on my interactions with many uranium investors is a disproportionate amount of attention to the upside relative to the downside of an investment. We spent a fair amount of time last summer screening the 70 companies in the sector and narrowed the list down to about 11 or 12 investable names. My question to you is, how would you advise investors to apply security analysis in a sector like uranium, which is very small and where the price movements of all 70 uranium equities are equally influenced by capital flows at the sectoral level?
I would suggest that the companies, I would suggest that you can employ traditional valuation methods on each of Kazatomprom, Cameco, and China General Nuclear. I think that you can look at weighted average cost of capital, return on capital employed, and in particular, if you can run net present value models on all of them. You need to understand that running accurate net present value models is almost impossible because the future is very large. It's a variable subject, but you can get indications of net present value, and securities analysis is all about the confidence that you might feel in the certainty of your forecast, and then the plurality of value over price. Which is to say, if you decide that Cameco, as an example, is worth $15 billion and the market says it's worth $9 billion, you're interested. Security analysis teaches you that money is made on the delta between price and value. And the delta between price and value takes a long time to work out. Benjamin Graham was looking for a margin of safety. He was looking to limit his downside, and he was looking to make his upside via compounding. And in the uranium business, with the investable names, you need to do the same thing. You need to run net present value calculations at today's price, call it $45, and at what the International Energy Agency suggests is the historic incentive price for uranium, which is about 60. And then at a price that you suggest might become the avoided cost if inflation continues on the supply chain and social rents, taxes, regulation, and royalties continue to drive up the operating costs of uranium producers. And so you need to, and you don't need to try to make this perfect because you can't. But you need to develop back of the envelope or thumbnail calculations around net present values at a matrix of price points. You need to think about the certainty involving, in particular, the conversion of resources to reserves and the capital costs associated with doing that. But once you've developed this very, very, very rough net present value calculation and thought some, not in an arithmetic sense, but rather in a prayed for sense, about the accuracy of your valuations, then you need to look at that number compared to what the market capitalization is today and try to figure out if you ought to care. If you come below those three companies in the universe of uranium companies worldwide, the valuation process becomes much more subjective. If you look at a company, a General Atomic, a Paladin, a NextGen, what you need to do is do the same type of analysis, but with much less numbers, much less valid numbers. You aren't going to be able to have certainty with regards to capital costs because you haven't built a damn thing. You can't have certainty around operating costs because you haven't operated the thing. You don't have certainty about price because you don't have certainty about price. What you can do is do models, preferably based on bankable feasibility studies, with your own implicit inflation calculations. Mine almost always exceed the calculations that are contained in bankable feasibility studies. And do the analysis that Mr. Graham does in securities analysis, but do it on a prospective basis. And remember again that the goal isn't to get it exactly right because you won't. The goal is to put in place base guidelines so that you can rank companies relative to each other and decide whether the reward on offer, if you're kind of right, justifies the risk that you might take. If you get further down the quality scale, and by the way, I love it further down the quality scale in bad markets, where you are in advanced exploration or even earlier stage exploration, the analysis there revolves around target size and probability, which is to say larger deposits are much better than smaller deposits, and around the resumes of the people that are engaged in the process. The further down the quality scale that you get, the sketchier the value proposition is. The more you have to ascribe value to the jockeys, to the people, and not to the horse. The fourth category, of course, would be optionality, pure speculation. Optionality, I would define optionality as buying for pennies a resource that would be worth dollars if a certain commodity price outlook occurred, understanding that you're buying something that is worthless today and that you will have to spend money on, A, to prove it up, but B, to continue to own it for years before the commodity price rises high enough to justify value. But where the resource is large enough and the probabilities of increased commodity pricing is high enough that the reward that you ultimately reap is a multiple of the price that you paid. Looking back at my greatest uranium success, which was Paladin, it was very clear at the time that I was financing John Borshoff to buy those assets that at the then existing uranium price, $8 to $10 a pound, those assets had no net present value. At $30 a pound, however, the price that I thought that uranium was going to go to, I thought that I could see a tenfold return in a price environment that I thought was realistic. What happened is that rather than the uranium price going from $10 to $30, it went from $10 to $140. And Paladin, as people are no doubt tired of hearing me say, went from 10 cents a share to $10 a share in 6 or 7 years. What's happened in optionality is that the money that some of us made in the precious metals market in optionality in the decade of the 1990s and in the uranium market in the period 2000 to 2006 was so extraordinary that a whole bunch of smart people are looking at optionality now. And the cover charge, the amount that you have to pay for a company that exhibits optionality, is now often so large that it obviates the benefit from optionality that people are trying to get. As an example, when I first invested is the wrong phrase. When I first allocated capital to Silver Standard, thinking that the silver price had to go up, the market capitalization of Silver Standard was 2 million Canadian dollars. When I first looked at Paladin as an optionality play in uranium, the market capitalization, if my memory serves me right, was 1.4 million Canadian. Very often now, companies that are marketing themselves to the public as optionality plays have starting market capitalizations at 100 million or 150 million. In other words, a whole bunch of the increase in the commodity price is already factored into the share price.
Do you think the size and liquidity in the markets today is very different from the last cycle? And what impact does it have on valuations from your perspective?
The fact that the market's larger and perhaps in the near term more illogical doesn't mean that you can afford to pay too much for something if you're a disciplined investor. It means that you can be right or wrong quicker, but it doesn't do anything to change the calculus between net present value and price. It becomes a variable. As an example, artificially low interest rates lower the cost of capital. Which means, as an example, that a development asset is theoretically more valuable during a period of time of low interest rates than it was during a period of time of high interest rates. So the size of the market and the liquidity of the market in terms of valuation matter just in the context of the cost of capital. They matter greatly in the near term in terms of investor behavior. But what I found is that the increasing emphasis on investor behavior is probably a function of very benign economic climates for 40 years and a lower cost of capital. And if we experience any hiatus in circumstances, which is to say, if the interest rate stops falling, if confidence in financial markets and financial systems subsides, the old disciplines of price to value in favor of behavioral finance will probably revert back to margin of safety and the delta between price and value.
We've discussed the topic of timing on our previous calls several times before. From my own experience as an investor in the commodities segment, I've found it is very difficult to put a finger on turning points in a cycle with any precision. And I also find that the catalyst for the turning point is often different from what we may have imagined it to be. This is a very common discussion that I have with many investors that are reaching out to us at Sprott regarding investments in uranium, gold, and silver today. I would like to close this discussion with your thoughts on the subject of timing.
I think the quest for accuracy or precision in terms of timing is a form of procrastination. I think it's impossible. I have always been early on the buy side, and I've always been early on the sell side. And as it ends up, that's worked out for me because I've taken plenty of fat slices out of the middle. To be a real investor, when things get cheap enough, you buy some. And if they continue to get cheaper, you buy more till it hurts. And then you keep buying if the market's on your side. It's a mistake I've made several times. It's very difficult to make your brain override your heart when either love or fear is involved. But you have to do it. More recently in the uranium side, I got that one right. I had big positions when nobody cared. And when the uranium equities prices outpaced the move in the commodity, and in particular, the smaller uranium companies began to discount $60 and $65 uranium in a $40 world, I had to sell. Now, interestingly, the hot money is leaving uranium at the same time that the certainty with regards to both outcome and timing is upon us. The price of admission has fallen by about half. That's a nice circumstance. Could it go lower? Of course. Am I early? Perhaps. But the lesson I've learned is that when industries where the commodity is a necessity for our form of life are producing the substance, the commodity, and selling it for a price that's less than the cost of production, which is to say, when the industry is in liquidation, either the price goes up or the material standard of living of humankind declines substantially. And the odds are for the former rather than the latter. And one must act. It's very rare that you get a set of circumstances like we're facing today, where you identify the arithmetic over a 5 or 6 year period of time, you develop a body of knowledge. The timing with regards to uranium, as an example, becomes clear to you. But because the events took longer to play out in the market than the market was willing to endure, the price of being right falls by half, or the cost of being right falls by half. That's a very rare circumstance, and one that I hope you learn to treasure going forward.